Hello and welcome to Sense and Sensibility, the Inflation Guy podcast. I am Michael Ashton. I am the Inflation Guy, and I am your host. And this episode of Sense and Sensibility is sponsored by Simplify ETFs, a fast-growing manager of liquid alternative ETFs. Simplify is bringing Wall Street to Main Street by providing access to institutional strategies perfect for diversifying your equity and bond portfolios previously only available to big institutions and the ultra-rich. Check out their website, simplify.us. That's simplify.us. And you can find their entire lineup of ETFs at simplify.us/ETFs. So today we're talking about the monthly CPI report. And, I've been saying, I said actually in the last podcast, that the common theme that we're going to be seeing for quite some time is uncertainty, volatility in terms of economic policy. But I'm here to tell you that, at least with respect to this month's CPI, the sky is not yet falling. Now, it's you really don't get a lot of eyeballs or earlobes, in the case of a podcast, by telling people that the sky isn't falling. That's the reason why when you look around, you see everybody saying that the sky is falling, because it just gets people much more animated, much more likely to listen to what it is that you have to say. But in my opinion, if you're always saying that the sky is falling, then you sort of lose credibility when the sky is not falling. And a lot of what we've read and seen and heard since the election of Donald Trump and the admittedly volatile policy moves that we've seen out of Trump, which, to be fair to his supporters, are a feature, not a bug. But the coverage of that has generally been of the character that anything that is big and sweeping and an important change from prior policies is the end of the world as we know it. And that for a while that really bothered me, because it seems to me that, when people are making big changes, especially if there's some plausible reason that they're making the big changes, you probably ought to at least wait and see whether they're right or you're right. To be sure, as an analyst, you've got to make a prediction. But a lot of what we're talking about aren't the analysts. We're talking news coverage, and news coverage should probably generally be, should accurately cover the almost unprecedented nature of the size of some of these policy changes, but at the same time should avoid some of the hyperbole about how, oh my God, we have the highest tariff rates since the Great Depression, which is true even after the temporary 90-day pause on Chinese tariffs. It's still true that we have the highest tariff rates in the United States since the 1930s. The difference, of course, is that back then we were actually we had a trade surplus, and we only imported about 2% of GDP. So while a lot of people like to say that Smoot-Hawley had something to do with the Great Depression, it really didn't have very much to do with the Great Depression. It just couldn't. It wasn't a big enough part of our economy, the external sector, so it's a popular thing to say that we have these great high tariffs that we haven't seen since the Great Depression, obviously trying to draw the connection between now and the Great Depression. But the reality is that this is really an entirely new circumstance where those big tariffs, especially because we net import a whole bunch of stuff, whereas back then we exported, is going to have a different effect. So drawing a parallel to the 1930s is just looking for trouble. But it does further the narrative that the sky is falling. Well, okay. Is the sky falling? Look, here's the overall context. We've been waiting here to figure out what tariffs are going to do to the CPI, to the price level. And we know that, or we think we know, that in the short run, we're going to see some tariff effect. You're going to see prices go up, but it's a one-time effect, okay? So if tariffs had remained on China of 90 or 130 or whatever the percentage was, if they remain at their full level on all the other countries we're tariffing, if they remain at their full level on Canada and Mexico and everything, then it would be the biggest impact. But it would be a one-time impact. And so the question is, well, after that, what happens to inflation sort of after this initial spike? And so that's sort of the big overarching question. It gets harder to answer when we have tariffs kind of go up and then go down, and so we don't have that stability. Now I believe what's going to happen is later this year we're going to have reached a stability. We'll know roughly what the tariffs are going to be on every good, and so I think at that point everything will start to settle down, and you'll start to be able to make meaningful forecasts of what's going to happen after that tariff adjustment. My personal opinion is that tariff adjustment is just not going to be as big a deal as you think, partly because a lot of what's happening here is that, we're the tariff effect has to do with really two things. One is how much of the thing we're importing, how much of that good is foreign sourced, and two is what's the price elasticity of demand for that product. And for things that have very elastic prices, either because we can acquire them from different places, like the example that I used a while back was tariffs on a particular country that exports a lot of coffee to us is going to have no effect to us because there's lots of providers of coffee. I worry about things like active pharmaceutical ingredients, okay, APIs that we get from China, where we get almost all of them of certain APIs from China. Very hard to sort of replace that in the short term, and we're very price inelastic, price inelastic with respect to demand. We need those things, and so that I would expect at some point, if we'd had 130% tariffs on China, and we haven't had a chance to produce any of these APIs domestically, then I would worry about the effect there. We'll get to that in a little bit. But the other part of the other context is, so that's one, so that we've got the tariffs. The other underlying context here is that Donald Trump just announced a policy over the weekend that he first mooted back in 2020, and I wrote an article about it back in 2020, and it's the most favored nation clause when it comes to pharmaceuticals. And basically the clause says that you can't sell a drug in the U.S. At a price any higher than the lowest price that you sell it in another country. And so if you've got a particular, you have Lipitor, okay? I'm just using that as a crazy example. But if you've got Lipitor and you sell it for $50 a dose in the U.S., and you sell it for $10 a dose in Bangladesh, then you can't sell it for more than $10 a dose in the U.S. And so the president announced this policy and said, well, that's going to lead to an immediate 30 to 70% decline in drug prices. That's not going to happen. And I give the president all the credit, and I give him, I guess, I'm willing to wait and see on a lot of policies, but he's just kind of plain wrong on this one. I mean, the economics aren't there. If the only way you get that kind of effect is if a drug company mindlessly says, "Oh, okay, I'm going to lower the price of Lipitor to $10," but that isn't the only option, right? So the drug company could stop selling in Bangladesh. They could stop selling in the U.S. They could lower the price in the U.S. some, raise it, somewhere else. That's what the president seems to think is going to happen. That could happen. Or depending on how much we need the drug, they could get an exemption. And I think that's what's going to end up happening mostly is that, drug companies are going to say, listen, we aren't going to be able to afford to sell this in the U.S. We sell so much of this around the globe that if we have to lower prices dramatically in the U.S., it'd just be better for us to be selling it elsewhere. And they'll go and they'll get exemptions. And it seems a strange timing for that announcement when you're trying to. And I think this is what the API, the pause in the Chinese tariffs was meant to do. It's meant to give us a little bit of time to go and replace Chinese sources for the things that we're very price inelastic on. I think those tariffs, a lot of them are going to go right back at the end of the 90 days, not to where they were, but they're going to go up substantially. But 90 days from now, hopefully we will have been able to replace some of the Chinese supply from other places or domestically. Well, if you're trying to replace active pharmaceutical ingredient production from China and you're trying to do it in the U.S. or elsewhere, then having a most favored nation clause is probably the last thing in the world you'd want to do, right? I mean, you kind of you'd like to have stability here in the U.S. So I think that a lot of those things will get exemptions, and one of the reasons that that you can suspect that other people believe that too is that yesterday when we had the big rally because of the tariff pause on China, pharmaceutical companies rallied as well. And if you really thought that prices in the U.S. for their products were going to go down 30 to 70%, you probably wouldn't be a big buyer of pharmaceutical companies right now. Obviously, investors don't really think that's going to happen, and I don't really think so either. So that's sort of the backdrop to today's CPI. Long-winded, but that's the backdrop here is really, really important. Okay, and so we come into this with this volatility in the back, and this fear from some quarters that we're going to start seeing these tariff effects, and the sky is falling, and there's going to be disaster, wailing, and gnashing of teeth. But the forecasts coming in were for about 0.25% on headline inflation, 0.27% on core. So much higher than the one-off induced numbers from last month, but not exactly runaway on the high side either. Pretty much normal. Those are pretty close to where the 6-month and 12-month averages have been. Actually, we got 0.22% on headline and 0.237% on core. That looks when you print them, it looks like that's a big miss because the forecast when you round it was for 0.3 on core, and we actually got 0.2 when you round it. So that looks like a big miss, but it really was 0.27 to 0.24. So, 3 or 4 hundredths of a difference. Clearly lower than expectations, but not a whole hell of a lot. What is interesting, well, there are a bunch of interesting things here, but one of the interesting things is that when you look at the 8 major subgroups, there are a lot of ways to split up CPI, obviously, but one of the obvious ways is the 8 major subgroups. So you have food and energy, you've got you have food and beverages, you've got medical care, you have other apparel, transportation, so on. Of the 8 major subgroups, only housing, medical care, and other rose 5 on a month-on-month basis. The other 5 major groups all declined, and the most surprising of those is apparel. Now, apparel doesn't have it's not a huge weight. It's a few percent. It's a major subgroup. I guess because at one time apparel is a much more important consumption item, but it's useful to look at because it is something that we import almost all of. We do very little textile manufacturing and apparel manufacturing in the United States, and we import a lot of it from the Pacific Rim. So when you see, if you expected to see a tariff impact, then you expect to see it in apparel. Now, I don't know what the price elasticity of demand is for apparel. I suspect that for some goods like underwear, T-shirts, some basic things, socks, they're probably reasonably price inelastic. You do have to buy some of those things. There aren't a whole lot of substitutes for them. For the higher priced goods, probably they're more elastic. But the bottom line is that apparel as a whole declined month on month. So doesn't appear to be any tariff effect there. And while some people pointed to some other categories that might have had tariff effects, it's really hard to get animated when a nice pure category like apparel is just showing no effects yet. Not saying there won't be effects. There will be effects, but they haven't shown up yet. And the important part about that is that, so we haven't really seen tariff effects, and yet core goods, which had been, of course, in COVID, massive inflation because we kind of stopped producing, and yet we airdropped money to everybody, so they were still buying, and so there were shortages of everything because of too much money, too much demand, caused shortages, caused prices to go up. And then over the last year or so, year and a half, we've seen prices decline, partially retracing that spike. Not entirely retracing it, but partially retracing it. And but we knew that when that ended, that core goods was going to end up, for many years, it's been slightly deflating. And my theme, my belief for some time has been that we would end up in slight inflation, so slightly positive core goods, just because that's part of the deglobalization effect. If we are bringing production domestically, it's going to be slightly more expensive production, and so you expect to have that happen. And right now, core goods is now up to about plus 0.13% year on year. So slight positive. And we're not going to get core goods at 4, 5, 6% or anything like that. I mean, maybe we get a little bit of a spike because of the tariffs, but it's not going to settle in there, right? So we're going to settle in at a small positive. And so the reason we care about that, I guess, or one of the reasons we care about that, is that if you're trying to think of how do I get inflation back down to 2%, then you have to remember that the last time we had it at 2%, we had core goods in deflation, like minus a quarter, minus a half. And now it's going to be in slight inflation mode. So that means that services, and in particular rents, have to be going up a lot less than they did the last time we had core inflation at 2%. And that's just not happening. Core services are decelerating, but they're not decelerating nearly, and they're not going to decelerate to the level where you say, okay, we're going to settle in at 2%. The median CPI is going to come in for the month at about 0.31%, which will have the year-on-year median CPI at 343. It could be slightly different from that, but that's my calculation. And that's pretty close. And that's basically where it has been, in mid-3s. Now, for a long time, I said we were going to settle in median inflation, high 3s, low 4s. Maybe we deviate a little bit above, a little bit below. I now think that mode is going to be mid to high 3s. Let's say that, with, again, some deviations below, some deviations above. I still think that when I say for a couple of years, it's going to be high 3s, low 4s, and I ultimately changed my forecast to mid to high 3s. I still think that was a pretty good forecast. But that's what it sort of looks like that now. So median this month, median last month, median for the last year or so has been pretty steady in sort of that range, around 0.3, a little bit above, a little bit below. Last month, core inflation was very low because of a bunch of one-offs. And so let's look at those one-offs. For example, jet fuel prices in March fell 5.3%. Not jet fuel, airfares. And airfares fell in April by 2.83%. And some of that's jet fuel and some of it's probably tourism. Lodging away from home last month fell 3.54%, and then this month, or April, was basically flat. I still think you're going to see continued downward pressure on lodging away from home as we evict some illegal migrants in some of the big cities that have been housed in these hotels, and so those rooms become available again. And because of any decrease in U.S. tourism. But the drop we had seen in March was just too big. And so I wasn't really surprised to not see lodging away from home go positive, but I would think kind of, something closer to zero, a little bit above, a little bit below, but kind of net down for a while is probably what you expect to get. Used cars declined about 0.5% in this month's CPI. Last month it was down 0.69%. And some people had thought that used cars would be up again this month. It had, after coming down a lot after the COVID spike, it had been floating positive again. It just happened that this month's seasonal adjustment was too big of a hurdle to overcome. So that's why we had used cars be negative. But I think it's actually going to end up being a little bit of a positive. However, to the Chicken Littles of the world, and the sky is falling, one of the things we'd heard was new cars and used cars prices are going to skyrocket because we now have all these tariffs on auto parts that we get from Canada. Well, those things we should see in the numbers because those tariffs went into effect before Liberation Day. And if they're in the number, they're not noticeable. New car prices were flat on the month. Used car prices declined on the month. It's not having a big effect. And again, I wouldn't necessarily expect that it would. There are other sources for used car or for car parts than Canada, including some domestic manufacturers. So I wasn't terribly worried about that, and it looks like I shouldn't have been. Getting to shelter, so shelter continues to flatten out. Actually, year-on-year primary rents went from $399 to $398, I think. So right about 4%. Owner's equivalent rent, a little bit higher than that. That's roughly where my model has it. 3.7 is where my model has it, and that's what kind of the actual numbers have been converging on that. Again, you've heard people for years, the last couple of years, say that housing and rents are in deflation or will be in deflation. They're not. There's no reason to think they're going to be. And so, our model has 3.7% and then gradually decelerating over the next year to 3.3 or something like that. And that's kind of what's happening. So again, getting back to the overall theme, if core goods is going to be positive and shelter is going to settle in here at 3.5%, then you better have something pretty good happening from Supercore, core services ex shelter. The good news there is that we do have something positive happening. Core services ex shelter has decelerated quite a bit. The bad news is that when you look at wages and you look at median wages versus median prices, so the supercore is that, core services ex rents is where the wage price feedback loop lives, right? So when you get into a circumstance where wages are declining much faster than prices, then that tells you that you're probably going to get some continual feedback that the core services are going to keep decelerating, right? So if wages decelerate a lot, that's going to pull down core services and vice versa to some extent. But over a long period of time, median wages as measured by the Atlanta Fed's wage growth tracker, tends to be about 1% above median inflation. And that's basically back to where it is. We're about that spread is about 0.9% right now, and that says that downward pressure on core services ex shelter is probably waning. Actually, median. So the Atlanta Fed's wage growth tracker was 4.3% this month. It was 4.3% in November, so it's just not going down anymore, and so that tells me that we're probably not going to, super core is probably not going to be able to decline enough to get us from the 3.5% median level to something closer to 2%. So, and that is, I think, the big conclusion. The big conclusion is we've been at 3.5%, or a little bit above it, a little bit below it for a while in median, and that's where we're going to kind of end up being. But I don't think there's anything about this situation that says that the Fed needs to tighten suddenly, or that and certainly nothing that allows them to ease suddenly. I think that, and I've said it before, that in the period of uncertainty like this, monetary policy should basically keep their hands off the steering wheel. Well, that's a bad image. Anyway, they should basically, let the economy do what the economy is going to do, and then decide later. And although Powell got some criticism for saying that recently, for saying we're going to wait for data rather than trying to anticipate it and get ahead of it, that's the right answer right now. Is let's wait and see, because we have a lot of very volatile things washing through the economy. And right now, there's no clear signal whether growth is going to be high enough and inflation too high, so the Fed should be, tightening, or growth is going to be weak and prices are going to continue to come down, so they should be easing, or you get some sort of stagflationary outcome where you have prices up and growth down, or you have the Goldilocks outcome where you have prices down and growth up. We just don't know which of those four things is going to happen. Probably the Goldilocks thing isn't going to happen, but the other three we don't necessarily really know. And the main thing the Fed should focus on, in my opinion, is to keep money growth quite low, because that's the only way you're going to get inflation from that mid-threes down to 2, is that we're going to have much slower money growth than we had in the 90s and the 2000s, because we have a different macroeconomic backdrop. I don't think the Fed realizes and believes that, but that's the thing that we should sort of watch going forward. But by going forward, I mean, that's something we're going to look at later in the year, right? I think right now we've got too many other things that are happening that are going to muddy the picture for the next 3 to 6 months. And until we have tariffs settled down and the effect is kind of, starting to wash through, until we know what the effect of the most favored nation thing is, and any other weird policy announcements that come out, I think the big ones are out. But until we sort of know what that is going to be, until we have all that out there and it's all started to settle down, the Fed's proper policy is really to just do nothing. The Fed doesn't really like to do nothing, not for some time. They haven't preferred the do nothing label, but that's probably the right thing to do. I do suspect later in the year they will do something. They'll probably ease, because that tends to be their overall bias, but probably not for a little bit. And that is all for today's podcast. Please like, subscribe, refer others. You can contact me at inflationguy@enduringinvestments.com. You can look at the blog, inflationguy.blog. It's a lot of what I just said, but in prose format. And there's a link at the bottom of the blog for the Telegram account for USDI coin. If you are in the crypto space, and if you invest in stable coins and are interested in an inflation-linked stable coin, then you should definitely take a look at that. And most of all, though, defend your money. And remember, if inflation is coming for you, you should remember you know about it.